Hey everybody, we are going to talk about SoFi today. SoFi has surged by 87% over the past year, but is down 30% from the highs that it reached just earlier this year. The company recently reported very strong first quarter results, so is now the time to buy. Today we're going to break down SoFi's current position, look at the threats and opportunities that face its business, and I'm going to give you my prediction for where this banking disruptor could be 5 years from now. So let's get right into the company's recent performance. In the first quarter of 2025, SoFi grew its revenue by 33% year over year. This is a pretty impressive growth rate considering how big the company's gotten. It has roughly tripled its membership base over the past 3 years. It now has just under 11 million total members, and it added 800,000 of them in the first quarter alone. That's the most it's ever added in a single quarter in its history. On the banking side of the business, SoFi didn't even get a banking charter till early 2022, and it's already grown its business from zero to over $27 billion in customer deposits that cover most of its loan portfolio. So now it's funding its loans with low cost capital. It is also becoming much more profitable. SoFi was losing money at first, like most growth companies do. 2024, SoFi achieved its first full year of profitability, not just on an adjusted basis or anything like that, but this is GAAP bottom line net income. SoFi was profitable every quarter of 2024. The first quarter of 2025 was actually a record high for the company in terms of earnings per share. Adjusted EBITDA in 2024 was 23 times what it was just 3 years ago. So not only is the business scaling very rapidly, but profitability is coming right along with it. So now we're going to take a look at the bull case for SoFi over the next 5 years. So there's a lot more to talk about with SoFi than I can go through in a 5 minute video, but there are a few important catalysts that investors should know about. One, SoFi just has excellent momentum and there's no signs of it slowing down anytime soon. The company has done a great job of building brand awareness. The SoFi Stadium deal is one big example, and it continues to use new brand campaigns to get its name out there, to get brand recognition, and to really position itself as a true banking alternative. The natural marketing funnel comes as it scales. SoFi started out as a lender, but has been emphasizing financial services like bank accounts, credit cards, investment accounts. As it grows that part of the business, which is the dominant part of the business now, it creates a natural marketing funnel to cross sell loan products that it makes most of its money from. The average SoFi member only has 1.4 products with the bank. A product is something like a checking account or an investment account. So just 1.4 per customer. There are a lot of opportunities to scale that and cross sell to the existing member base. Big banks, for example, the average person who has an account at Wells Fargo has 6 products with the bank. So there's a lot of room to grow, especially as the ecosystem scales. There's a lot that SoFi doesn't offer yet. Just to name a few, and I have no idea if they're planning on offering these anytime in the near future. It doesn't offer CDs through its bank. It doesn't offer a bunch of different investment account types. You can't open a custodial account for your kids, for example. It doesn't offer auto loans. Another big growth catalyst is its asset light loan platform that it's building out. Historically, SoFi has loaned its own money to customers, but now it's still doing that, but it's also scaling a third party loan platform where it originates loans on behalf of other banks. So it doesn't take any risk. Other banks are loaning the money, and SoFi just gets a nice stream of low capital light fee income without any risk for this. And it has billions of dollars committed to this already from other banks, and it's already had really impressive momentum in 2025. The student and home loan businesses. Student loan refinancing is what SoFi really started out to do, but personal lending has become the biggest part of its lending platform by far. Not surprising given how student loan forgiveness was in flux, payments were suspended during COVID and things like that. Um, so in the first quarter, that's coming back. Student loans originations grew by 58% year over year now that new administration's taken over and student loan forgiveness efforts have effectively been pushed to the side. Home loans, historically a pretty small part of SoFi's business, grew 54% year over year. And that's in a high interest environment. If interest rates come down and it's more affordable to borrow, especially when it comes to refinancing, this could be a big part of SoFi's business. But with all those factors, every investment has its risks. So it's important to talk about the bear case for SoFi. And there's three big things I would mention. So the first part of SoFi's bear case is valuation. It is not a cheap stock by any definition. It trades for 2.9 times tangible book value. That's roughly double what a big bank like Bank of America does. And it trades for 50 times forward earnings. I totally think the growth and momentum of the business really deserve a premium valuation, but it is priced for some future success. Execution risk is another big factor. If it was easy to disrupt the big banks, and SoFi wants to become a big bank, if it was easy to do that, an online bank would have already done it. It's not easy to do. It's really hard to get customers to switch from their banks that they've been using for decades. So a lot of execution risk in the years ahead and cyclicality. SoFi is a bank. When recessions come and things like that, demand for loans drop, and consumers might have trouble paying their bills if unemployment spikes, for example. So we can see default rates spike. There's a lot of cyclicality in this business. SoFi does best in a great economy, as all banks do. So where will SoFi be in 5 years? SoFi's management has said that its goal is to become a top 10 U.S. financial institution. It's currently at number 63 in terms of assets. For context, just some household names, numbers 9 and 10 on the top 10 list are Capital One and TD Bank. So it would need to get to this size to be on the top 10 list. SoFi currently has about $38 billion of assets. It would need to roughly 10x that in order to break into the top 10. I don't think it's going to get there in 5 years, but I could see the bank roughly tripling in size from its current membership base to about 30 million members within the next 5 years and getting to about $100 billion of total assets if it can keep this momentum going and take advantage of some of its opportunities. I also believe its net margins can continue to expand dramatically as they have been over the past couple of years. Profitability is a real focus, and I think it will continue to improve. The bank has an excellent net interest margin, more than roughly 3 times what Bank of America has, for context, and a great cost structure. It doesn't have branches to maintain or anything like that. So to be perfectly clear, SoFi is not a low risk stock by any definition. Things could completely go wrong, but it does have a ton of upside potential, and the risk reward dynamics make a whole lot of sense right here. And if management can continue to capitalize on its opportunities and profitably scale the business over the next 5 years, it could be a great stock for shareholders. Are you ready to discover more of the best opportunities in banking and beyond? Go to fool.com invest to get the top 10 stocks to buy right now. So that's it for today. Hopefully you enjoyed this discussion about SoFi, and please check out our other great content on our YouTube channel.